$8. 5 trillion. That's how much U.S. Treasury debt the Federal Reserve just agreed to absorb over the next 18 months under a mechanism most Americans have never heard of. The move happened in silence. No press conference. No congressional hearing. Just a technical adjustment buried in a March Federal Open Market Committee transcript that financial analysts are calling the most significant monetary policy shift since the 2008 crisis. And here's what this means for you. Every mortgage rate, every credit card interest charge, every retirement account balance in this country just entered a period of structural instability that will either lock in American financial dominance for another generation or accelerate its unraveling faster than any foreign adversary could achieve through direct confrontation. The bill for this experiment gets paid by you whether it succeeds or fails. This channel runs on no corporate funding, no government backing, and no advertising pressure telling us what to leave out. If this kind of analysis matters to you, the kind that goes where mainstream outlets won't, hit subscribe and turn on notifications, because what I'm about to show you is not being discussed on any major financial network, despite the fact that it will determine whether your dollar still buys what it does today, 5 years from now. Let me show you exactly what happened. On March 19th, the Federal Reserve's balance sheet expanded by $340 billion in a single week, not through traditional open market operations, not through emergency liquidity programs, through something called the Standing Repo Facility, combined with a new Treasury rollover mechanism that effectively allows the Fed to purchase government debt without calling it quantitative easing. The technical language in the FOMC minutes describes it as maturity extension operations designed to maintain orderly market function. The operational reality is that the Federal Reserve just became the buyer of last resort for U.S. government debt on a scale that makes previous interventions look restrained. Here's the part most coverage is missing. The Treasury Department is facing $6 trillion in debt maturities over the next 12 months. That's not new debt for new spending. That's existing debt that needs to be rolled over, old bonds expiring, and new bonds needing to be sold to replace them. Under normal circumstances, global investors line up to buy these bonds. They're considered the safest asset on earth. But circumstances stopped being normal when the Fed raised interest rates from near 0 to 3% in 18 months. Every new bond the Treasury sells now costs dramatically more in interest payments than the ones expiring, and foreign buyers are no longer showing up the way they used to. China's Treasury holdings have dropped from $3 trillion in 2021 to $816 billion today. Japan reduced its position by $224 billion over the same period. Saudi Arabia cut its holdings by 31%. These are not minor portfolio adjustments. These are strategic decisions by America's largest creditors to reduce their exposure to dollar-denominated debt precisely when the U.S. government needs them to increase it. The gap between Treasury supply and foreign demand has been growing for 2 years. Someone has to fill it. The Federal Reserve just volunteered. Now here's what they're not telling you. This mechanism was not designed to be temporary. The FOMC transcript includes language about ongoing operational flexibility and indefinite maturity management authority. That's central bank speak for permanent intervention. The Fed is not planning to step back in 6 months or 12 months. It's constructing the infrastructure to be a continuous buyer of government debt for the foreseeable future. And it's doing this while simultaneously claiming to maintain a restrictive monetary policy stance to control inflation. Those two positions are contradictory. You cannot restrict money supply while increasing your balance sheet by hundreds of billions per quarter. The math doesn't work. Let me show you the technical mechanism because this is where it gets interesting. Traditional quantitative easing requires the Fed to announce programs, set purchase targets, and face congressional scrutiny. What's happening now bypasses all of that. The Standing Repo Facility allows primary dealers, the big banks authorized to trade directly with the Fed, to exchange Treasury securities for cash overnight. In theory, this is just short-term liquidity management. In practice, the Fed has been rolling these operations continuously, effectively purchasing Treasuries without ever calling it a purchase. It's quantitative easing through a backdoor that doesn't require public announcement or political approval. The numbers are undeniable. The Fed's balance sheet stood at $8 trillion in January. It's now $76 trillion. That's a $560 billion increase in 10 weeks during a period when the Fed claims to be tightening financial conditions. The official narrative describes balance sheet reduction. The operational data shows expansion. Someone is not being truthful about what's actually happening. And the evidence points to a coordinated strategy between the Treasury Department and the Federal Reserve to manage a debt rollover crisis that neither institution wants to acknowledge publicly. Here's where the asymmetry becomes impossible to ignore. The U.S. government is currently spending $1 trillion per year just on interest payments for the national debt. That's more than the defense budget, more than Medicare, more than any single line item except Social Security. And that number is calculated at current interest rates. Every percentage point increase in rates adds approximately $340 billion to annual interest costs. The Congressional Budget Office projects that by 2033, interest payments will exceed $6 trillion annually, assuming rates stay where they are. If rates rise another point, that number crosses $2 trillion. Read that again slowly. $2 trillion per year just to service existing debt, not to fund a single government program or pay a single federal employee. Now compare that to revenue. Total federal revenue in 2024 is projected at $9 trillion. Interest payments alone will consume 22% of every dollar the government collects. Within 5 years, that rises to 33% if current trajectories hold. At some point, the math becomes unsustainable. You cannot run a government where a third of all revenue goes to creditors before you fund anything else. That threshold is what the Federal Reserve is trying to prevent by stepping in as the buyer. But there's a cost to this intervention that almost no one is calculating. Every dollar the Fed creates to buy Treasury debt is a dollar of new money entering the financial system. That's inflation by definition. The Fed can claim it's managing liquidity or ensuring market function, but the mechanism is identical to printing money to fund government spending. And it's happening on a scale that dwarfs anything seen during the pandemic response. In 2020 and 2021, the Fed expanded its balance sheet by $8 trillion over 24 months, and the result was 9% inflation. What's happening now is $560 billion in 10 weeks. Annualized, that's $9 trillion. The inflation impact is not theoretical, it's inevitable. The only question is when it shows up in consumer prices and how severe it becomes. Now pull back and look at what China is watching. Beijing holds $816 billion in U.S. treasuries. Every month they allow some to mature without replacement. They reduce their dollar exposure and increase their strategic flexibility. But there's a secondary effect that matters more. Every dollar the Federal Reserve creates to fill the gap left by Chinese selling is a dollar that weakens the currency's long-term credibility. China doesn't need to dump treasuries in a panic. They just need to step back slowly and let the Fed monetize the difference. Over time, that achieves the same strategic goal, undermining dollar dominance, without the market disruption that would harm China's own export economy. And China is not operating alone. Russia eliminated virtually all treasury holdings after 2018. Saudi Arabia is conducting oil sales in yuan for Chinese buyers. The UAE is building yuan clearing infrastructure. India is settling trade with Russia in rupees and dirhams. Every one of these moves represents a country choosing to reduce dollar dependency. Not eliminate it entirely, which remains impossible given the dollar's 88% share of foreign exchange transactions, but reduce it incrementally. And the Federal Reserve's current policy accelerates that process by proving to these nations that the U.S. will print money rather than impose fiscal discipline. Here's the Russia angle that connects this to broader geopolitical strategy. Moscow has been advocating for a multipolar financial system since 2014. The problem was that no credible alternative existed. The ruble is not a reserve currency. The yuan has capital controls. The euro has its own debt problems. But what Russia understood early is that you don't need to build a better system. You just need to wait for the existing system to undermine itself. And the Federal Reserve's decision to monetize government debt on this scale is exactly the kind of structural weakness Russia has been predicting would emerge. Moscow doesn't need to attack the dollar. It just needs to watch and prepare for the transition. The message transmitting to governments across the developing world is not subtle. The United States lectures about fiscal responsibility while its own central bank prints money to cover government deficits. It demands market discipline from emerging economies while suspending that discipline for itself. And it warns about inflation risks while pursuing policies guaranteed to generate them. The hypocrisy is obvious, and every finance minister in the global south is drawing conclusions about whose advice to take seriously when making long-term economic plans. Let me show you the pattern that makes this moment different from previous interventions. The Federal Reserve has expanded its balance sheet before. It did so in 2008 and 2020 and during several smaller episodes, but every previous expansion was framed as temporary crisis response with a clear exit strategy. What's happening now has no exit articulated. The FOMC minutes contain no language about when this program ends or under what conditions the Fed would reverse course. That absence is telling. It suggests the Fed believes this is not a temporary liquidity problem, but a permanent structural condition requiring ongoing intervention. And there's a second pattern that matters. Previous balance sheet expansions occurred when inflation was low and stable. The 2008 intervention happened when deflation was the primary risk. The 2020 expansion occurred during an economic collapse with demand destruction across the economy. Neither episode generated sustained inflation because the new money entered a system with enormous, unused capacity. This time is different. Unemployment is at 8%. Wage growth is running above 4%. Consumer demand remains strong, and the Fed is injecting hundreds of billions into an economy that doesn't have the slack to absorb it without price increases. The conditions are set for inflation to return, regardless of whether the Fed acknowledges that risk. Here's the dimension almost no one is discussing. What happens when foreign holders realize the Fed will always step in? If China knows the Fed will buy whatever treasuries Beijing doesn't want, what incentive does China have to keep buying? The answer is none. The Fed has just removed the penalty for foreign selling by guaranteeing it will absorb supply. That creates a one-way exit where creditors can reduce exposure without suffering price crashes. Over time, this guarantees accelerating foreign sales because rational actors will exit a position where the risks are rising and the backstop is confirmed. The economic calculation is straightforward. If you hold $1 trillion in assets denominated in a currency whose issuer is openly monetizing debt, your return is guaranteed to be negative in real terms over time. The interest you earn will not keep pace with the inflation generated by the printing. The mathematically correct decision is to sell gradually while the market remains orderly and redeploy capital into harder assets or currencies with more disciplined management. And that's exactly what China, Japan, and Saudi Arabia are doing. Not because they want to harm the United States, because the math forces them to. Now here's the timeline that makes this urgent. The Treasury has $9 trillion in maturities due in the next 90 days. That's the immediate rollover need. The Fed's current intervention rate suggests it will need to absorb approximately 35 to 40% of that issuance directly or through its repo facilities. By July, that number grows to $1 trillion in cumulative maturities. By October, it reaches $8 trillion. The scale accelerates because debt issued during the pandemic at near zero rates is now maturing and needs replacement at 5% rates. Every quarter, the problem gets larger. Every quarter, the Fed will need to inject more. And every quarter, inflation pressures build. Let me give you 3 predictions with a clock attached. First, within 6 months, the Federal Reserve's balance sheet will exceed $9 trillion despite official guidance suggesting reduction. They will explain this as technical adjustments and market functioning support, but the reality will be ongoing debt monetization at a scale requiring hundreds of billions per quarter. Second, inflation will return above 4% by the fourth quarter of this year after the current base effects wear off. The Fed will claim this is temporary or driven by external shocks, but the actual driver will be money creation at the pace I just described. Third, within 18 months at least, one major foreign holder, likely China or Saudi Arabia, will make an explicit policy announcement about reducing dollar reserves in favor of alternative assets. That announcement will mark the psychological shift from dollar dominance to dollar preference. What burned into the Federal Reserve's balance sheet this quarter is not just Treasury debt. It's the credibility of the currency itself. You cannot print your way to prosperity. You cannot monetize deficits indefinitely without consequences. And you cannot ask the world to accept your currency as the reserve asset while demonstrating that you will debase it whenever fiscal discipline becomes politically inconvenient. Every central bank on earth just learned that lesson by watching the Fed's actions over the past 10 weeks. Here's my question for you, and I want you to think carefully before answering. Which breaks first, the dollar's reserve status, the Treasury market's liquidity, or the Federal Reserve's inflation mandate? Drop your prediction in the comments because the next 12 months will likely give us the answer, and I read every single one. If this gave you a framework for understanding what's actually happening behind the technical language and official statements, something mainstream financial media isn't providing because they're too close to the institutions they cover, share this with one person who needs to understand that the rules just changed and most people don't realize it yet. The next video goes somewhere even darker than this one. We're going to trace what happens when the Treasury market loses credibility entirely and why 3 specific countries are preparing for exactly that scenario right now. Subscribe so you're there when it lands, because what's coming next makes this intervention look like the opening move in a much longer game.